Right now, an economic war is being waged not with tanks, but with tankers, and Russia is starting to feel the squeeze. On the calm, dark waters of the Indian Ocean and the South China Sea, a ghost fleet of aging oil tankers is playing a high-stakes game of cat and mouse, trying to deliver Russia's most vital commodity against a rising tide of global restrictions. This isn't just business, it's a battle for economic survival. The opening salvo of this latest chapter was fired in October 2025, when the West deployed its most powerful financial weapon yet against the heart of the Russian economy, its energy giants, Rosneft and Lukoil. The fallout was immediate and severe. In January 2026, the Kremlin's federal budget proceeds from oil and gas taxes are expected to collapse by a staggering 46% compared to the same month a year prior, plummeting to their lowest levels since the global economic turmoil of 2020. This isn't just a number on a spreadsheet, it's a direct hit on Vladimir Putin's ability to fund his government, his military, and his political stability. The sanctions are designed to do one thing: turn Russia's black gold into a financial black hole. So, how did we get here? What do these new sanctions on Rosneft and Lukoil actually do? And how is this economic showdown reshaping the global flow of energy, forcing countries like India and China into a difficult balancing act? The story involves clandestine ship-to-ship transfers in the dead of night, creative corporate accounting in Mumbai, and tense boardroom meetings in Beijing, all while the Kremlin scrambles to keep the oil and the money flowing. Stick with us as we break down what these sanctions really mean, who stands to win and lose, and how this economic showdown could affect everything from the price you pay at the pump to the balance of global power. This is the story of the West's high-stakes plan to defund the Russian state. The problem, a new kind of economic warfare. To get the gravity of the situation, we have to rewind to October 2025. This wasn't just another round of sanctions. It was a strategic escalation, a fundamental shift in the West's economic policy towards Russia. For months, the approach had centered around a G7 price cap, a complex mechanism designed to keep Russian oil flowing but limit the profits Moscow could make. But in October, the gloves came off. The United States and the United Kingdom executed a coordinated set of blocking sanctions against Russia's two undisputed energy champions, Rosneft and Lukoil. And they weren't alone for long. The EU followed up with its own powerful package in January 2026. These aren't minor players. They are the titans of the Russian state, together accounting for a massive share of the country's oil production and exports. Rosneft, the state-owned behemoth, is often called Putin's personal piggy bank. Lukoil is the largest private oil company. Hitting them is like targeting the twin engines of Russia's entire economic machine. So, what does a blocking sanction actually mean? It's not a tax, it's far more severe. When the US Treasury adds a company to its specially designated nationals, or SDN, list, it effectively excommunicates them from the US dollar-based global financial system. Any assets they have in the US are frozen. More importantly, almost any American individual or company is prohibited from doing business with them. But the real power lies in their global reach, through so-called secondary sanctions. This means any firm in a third country, a bank in Dubai, an insurer in Singapore, a shipping company in Greece that keeps doing business with Rosneft and Lukoil risks being cut off from the US financial system themselves. It forces a choice: do business with Russia's sanctioned giants, or do business with the world's largest economy. For most international corporations, that's no choice at all. This was a major pivot. The West moved away from the nuanced, and arguably less effective, price cap enforcement and returned to the raw power of sanctions. The goal was no longer just to limit Russia's profits, it was to make dealing with its main oil companies so toxic, so legally and financially risky, that a huge chunk of their business would simply evaporate. The sanctions came with wind-down periods, short windows for companies to wrap things up. The UK's deadline was the 28th of November 2025, various US licenses expired between then and April 2026. Those deadlines have now passed. The grace period is over. This created a totally new problem for Russia. The challenge isn't just about finding a country willing to buy its oil. Now, the Kremlin has to find a buyer, a shipper, an insurer, and a bank, all of whom are willing and able to operate completely outside the mainstream, dollar-denominated global system. They have to build an entire alternative financial and logistics chain for every single barrel, all while being hunted by the US Treasury. It's a logistical and financial nightmare on a scale the world has never seen. The Ripple Effect, Part 1. Russia's Logistical Nightmare. Faced with economic strangulation, Russia didn't just surrender, it activated a plan years in the making, the full-scale deployment of its shadow fleet. This shadow fleet is a sprawling, clandestine network of oil tankers, hundreds of vessels strong. These are typically older ships, re-registered in countries with lax regulations, their ownership deliberately hidden through shell companies. They often go dark by turning off their transponders, falsify their cargo's origin, or conduct risky ship-to-ship transfers of oil in the open ocean, far from prying eyes. This fleet is Russia's primary workaround. It's how Moscow can offer a complete package to a buyer. We'll not only sell you the oil, we'll handle the shipping and insurance ourselves, all outside of Western oversight. But it's a risky and inefficient strategy. The older ships are prone to accidents, and their Russian-backed insurance might not cover a major spill, making many ports nervous about letting them in. Recognizing this, Western regulators are now playing a game of whack-a-mole, actively targeting these shadow vessels. The European Union, in particular, is working to sanction the individual ships and front companies, trying to dismantle the network one tanker at a time. Even with this fleet, a new problem has emerged, a massive traffic jam on the high seas. As mainstream shippers backed away, Russian oil started getting stranded. This has led to a dramatic increase in floating storage. Russia is being forced to use its tankers as temporary offshore warehouses because there's nowhere else to put the oil. Huge flotillas of these tankers have been spotted idling off the coasts of Asia, a visible sign of the chaos. This has two dangerous consequences for Russia. First, it costs a fortune. Chartering an idle tanker runs tens of thousands of dollars a day. Second, and more critically, there's a physical limit. Once all the tankers and onshore storage tanks are full, the oil pipeline literally backs up to the wellhead. When that happens, there's no choice but to turn off the pumps. And that leads to forced production shut-ins, the most feared outcome for any oil nation. You can't just turn a Siberian oil well off and on like a tap. Shutting it down can cause permanent damage to the reservoirs. We're already seeing the beginnings of this. In December 2025, Russia was forced to slash its oil production by over 100,000 barrels per day. This wasn't a policy choice. It pushed Russia's output 250,000 barrels per day below its agreed-upon OPEC Plus quota, signaling that logistical bottlenecks were to blame. While the most dire predictions of massive shut-ins haven't happened yet, experts warn it's a matter of when, not if. All of this culminates in the most painful result for the Kremlin. The price it gets for its oil is collapsing. Even when Russia finds a buyer, it has to offer a steep discount to compensate for the risk. The price of Urals crude, Russia's flagship blend, has plummeted. The discount to the global benchmark, Brent, has widened dramatically to between 15 and 30%, pushing the effective price Russia receives down to levels not seen since the 2020 pandemic. Russia is now spending more money on a risky shadow fleet just to sell its oil for far less profit. But here's the crucial counterpoint. Despite all this, Russia's total crude export volumes remained surprisingly stable through 2025, and even jumped in December as it rushed barrels to market. The sanctions aren't stopping the flow of oil. What they are doing, with brutal efficiency, is crippling the flow of money back to Moscow. Coming up, we're looking at how this is hitting key buyers like India and China, forcing them into a delicate geopolitical dance. If you're finding this breakdown useful for understanding the forces shaping our world, take a second to hit that subscribe button. It really helps us continue making these deep dives. The Ripple Effect Part 2, The Buyer's Dilemma. The epicenter of this economic earthquake isn't in Moscow or Washington, but in the refineries and government offices of India, China, and Turkey. These three countries became Russia's economic lifeline, processing a staggering 1.17 billion barrels of its crude in 2025 alone. Now, the sanctions have put them directly in the crosshairs, forcing each to navigate a treacherous path between cheap energy and the risk of Western financial retaliation. Let's start with India, the world's largest importer of Russian seaborne crude. For over a year, Indian refiners had been gorging on discounted Russian oil. The October 2025 sanctions, however, changed the calculation overnight. The numbers tell the story. In December 2025, India's crude imports from Russia plunged by 29%, hitting their lowest level in over a year. This wasn't a moral decision. It was a cold, calculated response to risk. Indian refiners, especially private giants, are deeply integrated into the global economy. They export gasoline and diesel to Europe and North America, and the prospect of being locked out of those lucrative markets was terrifying. But what happened next was a masterclass in navigating sanctions, led by India's largest private refiner, Reliance Industries. Reliance operates a gigantic refinery complex cleverly divided into two parts. One, in a special economic zone, SED, is focused on exports. The other, a domestic tariff area DTA refinery, serves India's home market. In a brilliant pivot, on the 20th of November 2025, Reliance officially halted all processing of Russian crude at its export-focused SEZ refinery. This sent a clear signal to the West: our exports are clean. At the same time, it quietly continued, and in some cases increased, the flow of Russian crude to its domestic DTA refinery. This strategy lets Reliance have its cake and eat it too. It shields its valuable export business from sanctions while still supplying the Indian market with cheap fuel from Russian oil, a politically popular move. It's a legal loophole you could drive a supertanker through. So what's the outlook? It's highly unlikely India will stop buying Russian oil. The economic incentive is just too powerful. The trade will simply become more opaque, relying on smaller traders and the shadow fleet. Now let's turn to China. Its approach has been one of official caution and unofficial opportunism. China's state-owned oil giants like Sinopec and PetroChina have grown wary. They have assets all over the world and can't afford to be blacklisted. As a result, they've largely suspended direct purchases from the sanctioned Russian firms. However, that's only half the story. China's market also includes smaller, independent refiners, known as teapots. They are more agile, less exposed globally, and far more willing to take risks for a profit. They've become the primary entry point for Russian crude the state giants won't touch, working with discreet traders and the shadow fleet. Finally, there's Turkey, whose position is the most complicated. As a NATO member, Turkey is caught in the middle, and its compliance has been more pronounced. Turkish imports of Russian crude are down by 20 to 30% and are still falling. Major refiners like Star and Tüpraş publicly announced they would phase out Russian crude, and tracking data shows they followed through. For Russia, this fractured response is a mixed bag. The good news for the Kremlin is that the doors to India and China haven't slammed shut. The bad news is that every barrel sold to a teapot refiner in China or routed through Reliance's domestic refinery in India involves more risk, more complexity, and, crucially, a bigger price discount. The big picture, the economic fallout for Russia. The logistical nightmare at sea and the cautious dance of its biggest buyers are now translating into a full-blown economic crisis back in Russia. The sanctions are succeeding in their primary objective, cutting the link between Russia's oil exports and its state budget. The numbers are stark. As we mentioned, the forecast for January 2026 is a 46% year-on-year collapse in the government's tax revenue from oil and gas. This isn't an anomaly. It's the acceleration of a brutal trend. For the full year of 2025, Russia's budget revenues from oil and gas already dropped by 24%, falling to 8.48 trillion rubles, the lowest since 2020. Let's translate this into geopolitical impact. Independent analysis estimates the sanctions could slash Russia's annual oil and gas export revenues by anywhere from $30 to $55 billion. That could be a hit of up to 10% of the entire Russian state budget. Every $1 billion lost is $1 billion that can't be spent on tanks and missiles for the war in Ukraine. It's $1 billion that can't be used for social spending to placate a weary population. And it's $1 billion that can't prop up an economy creaking under international isolation. This is the core of the West's strategy, to starve the Russian state of the funds it needs to project power. The impact goes beyond the budget. Experts are calling this the most significant crisis for Russia's energy sector since the collapse of the Soviet Union. For decades, Russia's oil industry thrived on Western technology, investment, and expertise. That has all vanished. Now, it's being cut off from mainstream shipping, insurance, and finance. This leads to a slow but certain decay. Without access to cutting-edge drilling technology, new projects grind to a halt. As international service companies pull out, the efficiency and safety of existing operations decline. The long-term deterioration of Russia's most vital industry is accelerating. The sanctions are a massive geopolitical gamble. The West is betting it can cripple Russia's revenue without causing a chaotic spike in global oil prices that would damage their own economies. They're walking a tightrope. Russia, in turn, is gambling that its shadow fleet can outsmart Western enforcement. It is a high-stakes test of resilience against a backdrop of a dwindling treasury. The what-if, the next moves in the energy war. These sanctions, as impactful as they are, may not be the final move. If Russia proves too good at circumventing the current restrictions, the West has several more powerful weapons it could deploy. One is the so-called nuclear option, a complete ban on all maritime services for any tanker carrying Russian oil, anywhere. This would mean that mainstream insurance syndicates, like those in London, that underwrite most of global trade, would be forbidden from touching any Russian barrel. Without proper insurance, most ports in the world would refuse entry, effectively grounding Russia's export capacity. A second move would be to widen the company sanctions. Right now, the focus is on Rosneft and Lukoil. To close loopholes where oil is rebranded as coming from a smaller, non-sanctioned producer, the West could simply add all Russian oil producers to the sanctions list. A third, more incremental approach would be to get more aggressive in hunting the shadow fleet, dedicating more intelligence and naval resources to track and sanction these vessels and their owners on a rolling basis. Will the West choose to escalate? It likely depends on the state of the war in Ukraine and the price of oil. If the conflict intensifies, the political pressure to do more will grow. But if these moves threaten to cause a spike in gas prices back home, Western leaders might hesitate. On the other side, what are Russia's countermoves? The Kremlin isn't a passive victim. It could try to weaponize its remaining energy exports, perhaps by threatening production cuts with OPEC+ to deliberately drive up prices. It could also try to formalize an alliance with other sanctioned nations, like Iran and Venezuela, to create a cartel of the sanctioned that works to build alternative trade systems completely walled off from the West. The coming months will reveal which path each side chooses. The only certainty is that the stakes for Russia's economy, for European security, and for the global energy market could not be higher. So where does this leave us? The sanctions have undeniably marked a turning point. They haven't been a perfect blockade, and Russia's oil is still flowing. But the evidence is clear. They are systematically and severely crippling Moscow's oil revenues. We've seen how Russia has been forced into a corner, resorting to a costly shadow fleet, leaving its oil stranded at sea, and offering ruinous discounts just to make a sale. The result is a looming crisis for the Russian state budget, just when it needs the money most. At the same time, this isn't a simple story of Western victory. We've seen the sophisticated strategies being deployed by major buyers like India and China. They are finding ingenious ways to continue benefiting from cheap energy while minimizing their own risk, creating a new, fractured, and far more opaque global oil market. The West's economic pressure is creating the worst crisis for Russia's energy sector in a generation, but the Kremlin has proven resilient before. So the question remains, will these sanctions be the blow that truly cripples Russia's ability to fund its ambitions? Or are they just another obstacle that Putin's network of tankers and traders will, in time, find a way around? What do you think is the biggest risk in this new energy war, a global price spike, or Russia finding a way to win? Let us know your thoughts in the comments below. If you want to keep up with the story behind the headlines, make sure you're subscribed and have notifications turned on. Thanks for watching.